We've been talking a lot about housing this afternoon, and understandably so. While purchases of existing homes did jump 12% in December, our next guest says serious concerns remain. Radar Logic has just released the latest numbers for its RPX Composite Index, one of the most comprehensive measurements of home prices. And despite stable prices in November, the report says more declines are coming. Joining us now is Radar Logic CEO Michael Feder. So some folks are starting to say some optimistic things here. A little bit. You say what? Hold on here?
I would be cautious here. One, I think the NAR numbers that came out today, while somewhat encouraging.
You can't just say NAR number and assume that we know what you're talking about.
The existing home
National
sale
Association
number,
of Realtors.
Realtors is the key word.
Right. They said a price drop of 1% year over year, right?
Well, they also said an increase in activity, but it was a seasonally adjusted increase. And there's some question about whether or not their seasonal adjustment algorithm adjusted in turn for the fact that we had the tax credit pull through.
So maybe a technical glitch is what you're saying.
That's right. In fact, if you look at the non-seasonally adjusted numbers, they have declined from the National Association of Realtors in 5 of the last 6 months.
We say one of the most comprehensive measures of home sales when we talk about Radar Logic's index.
Talk about how you pick apart the data and what it's telling you about this housing downturn and where we are in this cycle.
Okay. As you know, Carol, we're not economists. We are trying to produce a surrogate for a spot market in housing as if it were a commodity. So we look at activity on a day-to-day basis. We look at cross points, point of sale, what's actually happening out there between buyers and sellers, and then we pull that all together to create the RPX values, which are actually daily prices. They're not indices. Our November monthly report shows that the activity that we saw in November of 2010 was 26% below the activity in November of 2009.
So worse.
So think about it. In the same time of year, which should be affected by the same seasonal forces, the volume we see is down 26% year over year. Now, that's not suggestive of a positive trend. Prices were somewhat stable in the month of November. We think that's an anomaly because typically the velocity of transactions leads prices. If volumes are increasing, prices are going to follow. When volumes are decreasing, prices are going to drop. The problem is still the inventory. And your last segment was really fascinating because people are starting to say we need to delever the system. And our concern, as you know, is we need to delever what's already in the system or we, the taxpayers, are going to bail it out.
I mean, how do we delever, though, what's already in the system? We all know it's out there. I mean,
it's a
And you think speeding up foreclosures, by the way, is a bad idea?
I think speeding up foreclosures is the worst thing we can do. The problem is you had an asset bubble associated with over-leverage. What you need now is new equity. Foreclosures would be the idea of throw it into bankruptcy and let somebody buy it for pennies on the dollar. The problem is if you do that, somebody has to lose the other pennies on the dollar, and that's, as you know, you and me. That's the taxpayer, and the number is huge.
Where does the new equity come from, though, that you're talking about?
Well, I think there are 2 ways to do it. One is that as the economy improves, and clearly there are some signs that maybe the weakness in the economy is softening, and that's obviously a good first step. As the economy improves, there are people who can buy houses today at prices they haven't seen in 10 years. So that will bring folks in. I think lenders have to be a lot more responsible. People are going to have to put more equity in. They're going to have to take better care of their houses, and that's fine. But what do we do about the 14 or 15 million homes that aren't paying their mortgages today or at risk of not paying their mortgages because they're too big? I think we have to do some sort of refi on those. And as you know,
and you've talked about that with us before.
We think there's a way to do that.
And you think that the way to do that is for the government to get in and take an equity stake with the people who are already in there? Well,
it's really the lender, Matt, because the lender is in effect right now the owner of that home. It's like any other capital structure. You got an asset, there's no equity. If you look at the asset value relative to the capital structure, the senior lender owns it. That's just the nature of the beast. If that senior lender wants to lose less than he will in a fire sale, then he's got to restructure that asset. It won't do you any good to throw that homeowner out because then you just got to go find a new one. So find a way to restructure, leave that homeowner there.
We got a few seconds. So Mark Zandi, who we follow closely, he's an accurate forecaster at Moody's.com. He says the housing market has bottomed. You don't buy it.
I don't. I'm a big fan of Mark's most of the time. On this case, I think he's wrong.
That was pretty straightforward.
as Michael always is.
He tends to be fairly straightforward. Michael Feder, thank you so much for joining us from Radar Logic.